Hello everyone, I'm John with JP Strategic Investments, and today I've got some important things to talk about with Rocket Companies and Dan Gilbert that I missed when I first analyzed the company, and it's really making me rethink my investment in Rocket Companies. This is something that in the company's own words could negatively affect their liquidity and potentially cost them over $11 billion. Now, I apologize to you guys for not seeing this sooner, and my only excuse is that Rocket's S1 filing, which is where this information was hidden, is over 700 pages long. But enough with excuses, let's get into what this is and how I'm actually adjusting my investment in Rocket after figuring all of this out. So over the weekend I was doing some research and digging into some things around Rocket stock, and I came across something called a tax receivable agreement that I had never heard of. Obviously I was interested in what it was and how it might affect the stock, so I looked into it and I ended up spending the next few hours reading into this and really trying to understand what this means for Rocket stock. So in case like me you've never heard of a tax receivable agreement, let me explain to you what it actually is. As most of you probably know, when you sell a stock for a profit you have to pay taxes on it. You may also know that if you end up with a loss at the end of the year, you can actually write off some of that money against your income in future years, which reduces the amount of taxes you owe in those years. Well, the same concept applies to a business. If a business is unprofitable for several years, once it becomes profitable, it can then write off some of those losses against the next several years' earnings, reducing the amount of taxes it owes in the years when it's profitable. Well, sometimes these write-offs can be very substantial and can end up saving the company huge amounts of money years into the future. Oftentimes, when a company goes public, pre-IPO owners like Dan Gilbert feel the public won't properly value these tax assets in the IPO sale, and that the losses he incurred to gain those write-offs won't be paid back to him. For this reason, tax receivable agreements have become popular with pre-IPO owners like Dan Gilbert. A tax receivable agreement is a contract in which the company pays the pre-IPO owners for the newly acquired tax assets as they use them. Now, in a way this does seem fair. I can understand how Dan would want something in return for all of the time and money he poured into the company before it was profitable. The downside, though, is that it means that the public company doesn't actually benefit from these tax assets, and in this case, Rocket has to give 90% of the tax savings from these assets as a payment to Dan every quarter. Now, at the moment, because Rocket Companies only owns 7% of the business, they only have to pay him for 7% of these assets. But the company's S1 states that assuming Dan decides to convert more and more shares over time, this could end up costing the company over $11 billion. And how quickly they have to pay him is entirely up to when he converts the shares and when they can use the assets. This means that depending on the situation, there could be times when the amount that they owe to Dan Gilbert is actually more than the tax savings that they're getting from using the assets, and in order to pay him, they would have to pull money from their balance sheet. Rocket also states that because of this agreement and the structure of the company, in certain cases RHI and Dan Gilbert's interest may be in conflict with the interests of the shareholders, which in my opinion is never a good thing. Now, if you need to rewatch any of that or pause and read the screenshots, I totally understand. I had to read a lot of this multiple times to really wrap my head around it. If you think you have a good grasp on it though, I'm going to get into what this all means for the stock and how I've adjusted my investment in Rocket Companies accordingly. So, as I said before, I understand why a pre-IPO owner like Dan would want to make this agreement. That being said, the payments from this agreement will likely be weighing on Rocket's earnings for years and could potentially cost them over $11 billion. Now, none of this changes my opinion that Rocket is undervalued and that they are gaining huge chunks of market share as a result of UWM's ultimatum. Although I believe that if the near-term catalysts that I've just mentioned don't play out, the payments of the tax receivable agreement could potentially be a drag on the company's earnings for years into the future and could dampen future returns on the stock. Not to mention the fact that Dan Gilbert's interests may be in conflict with those of shareholders in certain situations as a result of the agreement. For these reasons, I've decided to sell all of my shares and instead enter into several different options positions. This way I can still take advantage of any jumps in the stock over the next year or two without having to tie up too much money in the stock. I think that the biggest downside to Rocket stock as a result of this tax receivable agreement could be the opportunity cost. I would much rather lose the very small amount of money that I just put into the options over the next 2 years than have a large amount of my money tied up in the stock that could potentially be held up by this agreement. That way I can use the extra money in other places to benefit my portfolio. If you're interested in exactly which options I bought and any other trades I'm making, you can always join my Discord server where I go over exactly what trades I'm making and discuss stocks and strategies with other members. I hope you found this analysis helpful, and if you did, please consider liking and subscribing. Other than that, see you next time and have a great day.